Term versus permanent life insurance. What's best for your family? Planning for your family's financial future is a big responsibility, and life insurance can play a key role in ensuring their security. In this guide, we'll compare term life insurance and permanent life insurance to help you decide which option best fits your needs. We'll also explore what the Bible says about providing for your loved ones, include a detailed comparison table, and highlight specific scenarios where each insurance type shines. As of July 2025, the core distinctions between term and permanent life insurance remain unchanged, though premium rates may vary due to economic factors. Always check with providers for current quotes. Let's dive in and find the right choice for your family. Definition of terms. Life insurance. This is a contract where you pay an insurance company regularly, and in return, they provide money to your family if you pass away to help cover their expenses. Term, life insurance. This is like renting protection for a specific period, such as 15 years. If you die during that time, your family receives a payout. If you're still alive when the term ends, the policy expires and you receive no money back. Permanent life insurance. This is like owning protection that lasts your entire life. As long as you pay the premiums, your family gets a payout whenever you pass away, and the policy includes a savings component you can use while alive. Premiums. These are the monthly or yearly payments you make to keep your insurance active, similar to a subscription fee. Death benefit. This is the amount of money your family receives from the insurance company if you pass away. Cash value. This is a savings account within permanent life insurance that grows over time, allowing you to borrow from it or use it later, like a piggy bank. Convertible term. This is a term life policy that allows you to switch to permanent insurance later, even if your health declines, without requiring a new medical exam. Beneficiary. The person or entity, for example, spouse, child, or trust, designated to receive the death benefit upon the policyholder's death. Policyholder. The individual who owns the insurance policy, responsible for paying premiums and entitled to any cash value benefits in permanent policies. Underwriting. The process by which an insurer evaluates an applicant's health, lifestyle, and other factors to determine eligibility and premium rates. Policy lapse. When a policy terminates due to non-payment of premiums, resulting in loss of coverage and, in permanent policies, potential loss of accumulated cash value. Surrender value. The amount a policyholder receives if they voluntarily terminate a permanent life insurance policy before maturity. Typically the cash value minus any surrender fees. Let's talk through the comparison table to figure out what's best for your family. We'll use Tom, a 55-year-old dad with a 3-year-old and a 6-year-old, and Victoria, a 45-year-old business owner, to show how these features apply in real life. The definition outlines the core of each insurance type. Term life insurance provides coverage for a specific period, such as 10, 20, or 30 years, and only pays out if you die during that time. Permanent life insurance covers you for your entire life as long as you pay the premiums, and it includes a savings component called cash value. For someone like Tom who needs protection until his kids are grown, term life's temporary coverage fits perfectly. For Victoria, who wants lifelong security and estate planning, permanent life's ongoing coverage is ideal. The duration highlights how long each policy lasts. Term life insurance is temporary, expiring at the end of the chosen term, like a lease that runs out. Permanent life insurance lasts your entire life, assuming you keep up with payments, similar to owning a home forever. Tom needs coverage for 15 years until his youngest child is 18, so a term policy aligns with his timeline. Victoria, planning for her business and estate, benefits from Permanent's lifelong guarantee. Premiums are the payments you make to keep the policy active. Term life insurance has lower, fixed premiums for the duration of the term. For example, Tom might pay $50 to $150 a month for a $500,000 policy if he's healthy. Permanent life insurance has higher premiums, often $300 to $1,000 a month for the same coverage, and they can be fixed or variable depending on the policy type. The higher cost for permanent comes from its lifelong coverage and extra features. Tom's tight budget makes the term's lower premiums a better fit, while Victoria's higher income allows her to afford the permanent's cost. The cash value is a big differentiator. Term life insurance offers no cash value. It's purely about providing a death benefit if you pass away during the term. Permanent life insurance builds a cash value over time, like a savings account you can borrow from or use later. This makes permanent a dual-purpose tool. Insurance plus savings. Tom doesn't need the savings component since his focus is affordable protection for his kids, but Victoria can use the cash value for retirement or business needs. Cost ties closely to premiums. Term life insurance is more affordable, making it ideal for those on a budget who need significant coverage without high payments. Permanent life insurance is more expensive due to its lifelong coverage and cash value accumulation. For Tom, term's affordability means he can cover his family without sacrificing other expenses like daycare. Victoria, with more financial flexibility, can handle permanent's higher costs for its added benefits. The payout, or death benefit, is what your family receives if you pass away. With term life insurance, the payout only happens if you die during the term. Otherwise, there's no benefit. Permanent life insurance guarantees a payout whenever you die, as long as premiums are paid. Tom's 15-year term policy ensures his family gets $500,000 to $1 million if he passes before his kids are grown, but nothing if he outlives the term. Victoria's permanent policy ensures her family or estate gets the payout no matter when she passes. Flexibility refers to how adjustable the policy is. Term life insurance is less flexible. When the term ends, coverage stops unless you renew or convert to permanent, often at a higher cost due to age or health changes. Permanent life insurance offers more flexibility, allowing you to adjust premiums, borrow from cash value, or modify the policy in some cases. Tom's straightforward needs don't require much flexibility, but Victoria benefits from permanent's options to tweak her policy for her business or estate plans. Complexity describes how easy each policy is to understand. Term life insurance is simple and straightforward. You pay, you're covered for the term, and that's it. Permanent life insurance is more complex due to its cash value and investment components, which can feel like managing a financial account. Tom prefers term's simplicity to focus on his family, while Victoria is comfortable with permanent's complexity given her business-savvy background. Policy types show the variations available. Term life insurance includes standard term, renewable term, which lets you extend coverage, and convertible term, which allows switching to permanent. Permanent life insurance includes whole life, fixed premiums and benefits, universal life, adjustable, variable life, investment linked, and indexed universal life, tied to market indexes. Tom might choose a convertible term policy for future flexibility, while Victoria might opt for whole life for its stability or universal life for adjustability. Finally, renewal conversion addresses what happens at the end of the policy. Term life insurance can often be renewed or converted to permanent, but renewing typically means higher premiums due to older age or health changes. Permanent life insurance requires no renewal. It continues indefinitely as long as you pay. Tom's term policy could convert to permanent if his needs change, but Victoria's permanent policy just keeps going without worry. Term life insurance. Scenarios for who would benefit. Term life insurance provides coverage for a specific period, typically 10 to 30 years, at a lower cost, making it ideal for temporary financial protection needs. It doesn't build cash value, but offers a death benefit if the policyholder passes away during the term. Here are common scenarios where it excels. Young families starting out. Young families starting out. If you have young children, term life insurance provides affordable protection to replace income, cover childcare, or fund education during the years your dependents rely on your earnings. It's perfect for those on a tight budget needing high coverage amounts. Importantly, it's wise to insure both spouses, even if only one works outside the home, as the non-working spouse's contributions are invaluable, and their premature death could lead to significant financial strain. For instance, if the stay-at-home spouse dies, the surviving partner might need to pay for daycare, averaging $12,000 per year per child in many states. Hire tutors to maintain high-achieving kids' academic progress, often $5,000 to $10,000 annually, and outsource household cleaning and maintenance. potentially $2,000 to $5,000 yearly, all while managing work demands. According to a 2024 analysis by PSECU, the economic value of a stay-at-home parent, encompassing childcare, education support, meal preparation, cleaning, and more, is estimated at around $184,820 annually. This underscores the need for term life coverage on both spouses to prevent devastating financial loss and ensure family stability. Homeowners with a mortgage. If you recently bought a home, a term policy aligned with the mortgage duration, for example, 20 to 30 years, ensures the loan can be paid off if you die unexpectedly, preventing financial strain on your family. For example, consider a husband and wife with no children who own a home with a 30-year mortgage. If one spouse dies, the surviving spouse might not be able to afford the mortgage payments on a single income, potentially leading to foreclosure or forced sale. A term life policy covering the remaining mortgage balance would provide the payout needed to pay off the loan, allowing the survivor to stay in the home without financial hardship. Renters without children. For a husband and wife without children who are renting, a term life policy covering 1 year of rent, for example, $20,000, if half of the rent is $1,667 per month, gives the surviving spouse enough time and money to move to a smaller, more affordable apartment without immediate financial pressure, allowing them to adjust to life on a single income. Budget-conscious individuals with short-term obligations. If you have temporary needs like funding college for kids or covering funeral expenses during a specific life stage, term life insurance offers simplicity and lower costs compared to permanent options. New business owners. New business owners, such as entrepreneurs like Michael and Craig launching a startup, often opt for term life insurance due to its affordability and alignment with the high-risk early stages of a venture, allowing them to allocate resources toward growth while protecting their families and partners from financial fallout. In this setup, partners like Michael and Craig can purchase term policies on each other's lives, naming the other or the business as the beneficiary. If one dies prematurely, the tax-free death benefit, potentially $500,000 or more, provides a crucial financial cushion to cover debt's operational costs, hire replacements, or fund a buy-sell agreement to acquire the deceased's share, thereby preventing bankruptcy and ensuring business continuity. This key person insurance or cross-purchase structure is far cheaper than permanent life insurance. For example, $78 to $100 monthly for a 20-year, $500,000 term policy versus $750+ for whole life. Matches the temporary high-risk period of 10 to 20 years and can be tailored to the business's valuation and needs. Permanent life insurance. Scenarios for who would benefit. Whole life insurance offers permanent coverage for your entire life as long as premiums are paid and includes a cash value component that grows over time. It's more expensive but provides lifelong security and financial flexibility. Here are scenarios where it makes sense. Individuals planning for estate and inheritance. If you're focused on leaving a legacy, whole life insurance can cover estate taxes, funeral expenses, or provide a guaranteed inheritance to heirs, making it a key tool for long-term estate planning. Those seeking cash value for financial flexibility. If you want to build a tax-advantage savings component, the cash value in whole life insurance can be borrowed for emergencies, retirement supplements, or even premium payments, ideal for higher-income individuals treating it as a conservative investment. People concerned about future health or insurability. If you have or anticipate health issues that could make getting new insurance difficult later, whole life insurance locks in coverage for life without further underwriting, ensuring protection even if your health declines. Families seeking lifelong protection. Whole life insurance offers peace of mind with a fixed, non-expiring death benefit, ideal for those who can afford higher premiums and want to ensure coverage never lapses, particularly for permanent dependents. It suits policyholders naming a stay-at-home spouse as beneficiary, especially if the spouse lacks sufficient Social Security credits due to supporting the family business or raising children, or for those with disabled children requiring ongoing financial support. Additional considerations. Convertibility. Many term policies, like the one Tom might choose, allow conversion to permanent insurance without a medical exam, offering flexibility if needs change, such as if Tom develops health issues and wants lifelong coverage, health and age. Term life insurance is cheaper for younger, healthier individuals, but premiums increase with age or health changes upon renewal. Permanent life insurance locks in coverage regardless of health changes, benefiting those like Victoria with long-term plans. Financial planning. Life insurance is a great supplement to investments, but unwise as a primary investment, as its core purpose is financial protection against devastating loss from premature death. Permanent life insurance's cash value grows modestly, 2 to 5% annually compared to stocks, 7 to 10%, primarily ensuring a lifelong death benefit for dependents like a stay-at-home spouse or disabled children. Term life provides affordable, high-coverage protection for temporary needs, such as a $500,000 policy for $78 to $100 per month for a 51-year-old male, versus $750 to $800 for whole life. Both types prioritize risk mitigation, complementing investments by securing financial stability for loved ones or businesses, but they should not replace higher yield strategies like IRAs or 401ks. Risk tolerance. Term life insurance is low risk and simple, ideal for those who want straightforward coverage. Permanent life insurance involves more complexity, especially with investment-linked policies like variable universal life, which may carry market risks. Teaching biblical personal finance to your family and community. Teaching your spouse and kids about biblical personal finance is extremely important because life insurance would not help them long-term if they never learn how to handle money. While a life insurance payout can provide immediate financial relief, without the wisdom to manage it responsibly, it could be squandered quickly, leaving your loved ones in a worse position over time. As part of the kids' training, they should be taught about it from a young age, instilling principles like stewardship, generosity, and wise spending based on Scripture. Having said that, most adults also do not know much about biblical personal finance because they're not taught in public schools. This gap in education means many people enter adulthood without understanding concepts like avoiding debt. Proverbs 22:7. Just as the rich rule the poor, so the borrower is servant to the lender. Saving diligently. Proverbs 21:20. The wise have wealth and luxury, but fools spend whatever they get. Or giving generously. 2 Corinthians 9 verses 6 to 7. Remember this. A farmer who plants only a few seeds will get a small crop. But the one who plants generously will get a generous crop. You must each decide in your heart how much to give. And don't give reluctantly or in response to pressure. For God loves a person who gives cheerfully. So, we need to spread this knowledge out to our community so that when you die prematurely, your beneficiaries won't use it all in one go. By sharing these teachings through family discussions, church groups, or community workshops, you can help ensure that your legacy endures through wise financial habits rooted in biblical truth. Summary. What's best for your family? You should choose term life insurance if you need affordable, temporary coverage for specific needs, such as protecting young children or paying off a mortgage, and prefer simplicity. For Tom, a 15-year term policy ensures his wife and kids are supported until they're 18, keeping costs low and manageable. You should choose permanent life insurance if you want lifelong coverage, have the income to afford higher premiums, or need cash value for long-term goals like retirement or estate planning. For Victoria, a whole life policy supports her business and estate needs with lasting security and savings. Ultimately, the best choice depends on your budget, goals, and how long you need coverage. For most families like Tom's, term life insurance offers affordable protection for key years. For those like Victoria with complex or lifelong needs, permanent life insurance provides enduring security and financial flexibility. Remember to incorporate biblical principles. Provide responsibly without hoarding. Consider designating a portion of the payout for God's work, and teach your family and community about biblical personal finance to ensure the benefits last beyond the immediate payout. Disclaimer. This guide is for informational purposes only and does not constitute financial advice. Always consult a licensed financial advisor or insurance professional to evaluate your specific needs and circumstances before purchasing life insurance. Premiums and policy details may vary based on providers, health, age, and other factors. For more tips on managing your finances and investing through brokerage accounts, subscribe to my channel to explore my other videos on building wealth and securing your family's future.